All right, we are on another amazing Monday with a phenomenal speaker. This is a great speaker who we've had before, and I can't remember the member who actually brought this up or said or gave us the idea for this one, but she said we should talk a little bit more about taxes. And the bigger thing is, this is the time of year where we should be doing tax planning and tax strategizing, not waiting until January where there are certain things that we simply can't do. But definitely just not waiting until the end of the year where maybe from a cash flow perspective, you're unable to take advantage of some of the things that you might want to do in terms of getting things ready, in terms of strategizing, in terms of looking at your options, in terms of seeing if you should make certain expenses or not, knowing how those things might actually impact your tax liability at the end of the year. And so when we talk about should you make this decision or that decision, should you do pre-tax versus post-tax and all those kind of things, it's key for us to really strategize how does that play into the bigger picture. And so there is no one size fits all when it comes to the tax plan, because of course we all have different incomes, we all have different goals. Some of us own businesses, some of us own real estate, and so forth. But we have Jessica Webb with us today, who is a CPA out of Houston, Texas. She strategizes with a number of business clients, really talks with a number of people one-on-one as they try and figure out what next, or as they just kind of graduate out of the simple tax preparer type lifestyle. And so thank you once again, Jessica, for joining us. Let's get started and jump right on in. You all know the rules. There are very few. The biggest rule is engage with us, ask the questions that you want to hear and know more about. If we kind of go on a tangent, I'll definitely make a note, make sure that we address those items later. But we want to get into a little bit into the meat of tax planning and a little bit of tax understanding. So when people make some of the kind of blanket comments, or they're like, oh no, I do this way or this way, then you'll have a better understanding of how that applies to your situation. So without further ado, I want to hand things off to Jessica Webb.
Thank you so much, Rosalind. Thank you guys for having me. Rosalind, for allowing me to be on this platform and to be a part of what you're doing here. It's so necessary. And I learned stuff just by reading the comments. And so it's all helpful. So guys, if you got questions while we go over this information, please stop us. Don't hesitate to stop me and let me know. I am going to share my presentation. Not that side, you need this side. All right. So today we're talking about understanding taxes. Dun, dun, dun. Taxes can be scary sometimes, and we want to make it less scary. Two things are certain in this world. In a world of uncertainty, like 2020 has been so uncertain, so many things up and down, but we know there is death, unfortunately, and we know that we'll have to pay taxes. So today I'm going to start off with a little history about income taxes. So in putting together this presentation, I found out a lot of cool things, and I think it's some parallels to what's going on today. We could talk about that later. But once upon a time, not long ago, income taxes have been traced back to Egypt. And for all you Bible scholars out there, you could look at Genesis chapter 41:34, and it's an example of Joseph is the second in command to Pharaoh, and Pharaoh has this dream, and as a result of the dream, there's a famine. God sent him a message saying that there was a famine coming, and so they decided to tax the people, which is they took resources from everyone in order to provide resources for everyone later on. So the first time we see taxes in history is in Egypt. And then you're familiar with give Caesar what is Caesar. Some people have heard that saying before. So in Rome, they definitely had taxes. And then in Great Britain, in the early 1700s is when we first start to see what's called the progressive tax system, which is what we have today. And progressive means that as your income increases, so does your level of taxation. So now we're going to talk a little bit about U.S. history. So U.S. history around income tax, we have fought wars over whether or not to pay taxes. The Boston Tea Party was a fight over a tax on spices, sugar, and tea. And it was the beginning of the American Revolution. So no taxation, and people were saying no taxation without representation. Sorry, DC, maybe soon you guys will get more representation. Then there was a tariff system. At the time, there was a tariff system, and that's kind of part of what was going on with the Tea Party. And at that time, it was the largest source of revenue for the United States, this actual tariffs, kind of like what we have with China, actually, and the things that we import from them. So the things that are going on now are actually factors way back then. So later on, a cool thing about before the 16th Amendment was passed, there was an income tax, and there was some back and forth with Congress about whether or not to have an income tax. But when we went into Civil War, the United States decided that we have to have tax to pay for the war. And later on in 1913, that's when the 16th Amendment was passed, and it gave Congress the right to the power to lay and collect taxes on income from wherever sources were derived. So I wanted to get into the tax rates. Now, it's something we don't talk about often, about what are the historical tax rates. And if you look closely, in 1913, when the 16th Amendment was passed, the marginal tax rate, which is the marginal tax rate, means the tax you have to pay on the next dollar that you receive. So if your income is at a certain level, the marginal tax rate means that's the highest tax rate you would pay if you receive like for every additional dollar you receive. So at the time in 1913, it was 7%. Then if you look, it gradually goes up. It was 7% from 1913 to 15, and then 16, something happened, it became 15%. And then in 1917, it was 67%. So notice, in a year's time, it went from 15% to 67%. Then it kind of hovered in the 70s, and from 1970 to 1921. So if you guys like history like me, you would notice that this is actually, I got too excited. This is actually a time of war. This is World War I. 1970, 1918, 1919, 1920. And then we go into like the Roaring 20s, which is the economy was booming from 1920 to 1929. The tax rate went from 1920, it was 73%, and then it gradually decreased to 1929, where it was 24%. Now, again, it started at 73%, then went down to 24%. By 1929, which is also when the stock market crashed. And then during the Great Depression, in 1930, the start of the Great Depression, it was 25%. And towards the end of the Great Depression, we're looking at in 1940, 1941, as part of the New Deal, the tax rate was still high because that is how the country pays its debts and how the country runs. It's a business. And so the United States, in order for them to make money, they have to tax us. So again, let's look at this rate. I'm harping on these rates for a reason. So during the Great Depression, it went from a low tax rate to a higher tax rate. And then just crazy towards the end of the war, the end of World War II was 1945. It was 94%. 94% of the income you receive being taxed. That just blows my mind to think of. I'm working for the government. I will continue. And so we see, if you look through the 1940s and the 50s, you pretty much have 91%, 90, 80, 90%. And then it gradually goes down, 70%, 50% in the 80s. And then there was a big change in 1986, was a huge tax reform, similar to what we see with President Trump's tax reform in from 2018. And the tax rate went from 50%, the marginal tax rate, to 38. And we've kind of hovered there for the last 30 years. So I will keep going. So this is what I mean by, here's an example of progressive tax system. So these are actual tax brackets for 2020, unless they change it later this year, which they could, depending on who's in office. They might decide that we need to change this, but as of right now, these are the tax rates at each income level. There's different tax rates. So if you are single, there's a different tax rate if you are married filing joint. If you are married but you don't file with your spouse and you married filing separate, you are in the single tax bracket. And there's also head of household. So that might be an unmarried person who is claiming a child.
Now, Jessica, if you want to go back there, I think it's key to make sure that people understand. Well, front and forward, yes, this one. So it's key for people to understand. So if you made $80,000, you're not paying 24% on the entire $80,000, correct?
Great point. Yes. So that is at 8. If let's say you make $86,000, your taxable income is $86,000. Well, the tax bracket here for 24% is $85,000. So anything over $85,525 is where you're paying the 24%, and that's part of that progressive tax system. From $0 to $9,000, you're paying 12%. And so each bracket is kind of like the in between. So that 9,000 to 4,000 is the level between 12 and 22. So you're correct. You're not paying the full 24% on all your dollars. You're paying it only on the amount that's over the amount listed here. So the first, So we used to be 0. Go ahead. Did you have another question, Rosa?
No, I was going to say it kind of goes back to the point where people talk about things or issues that could put you in that next tax bracket. So you might not necessarily want to go over, if you're making, let's say, $80,000 and you have the ability to time income. So you have the ability to time $10,000 worth of income. Can it be time for 2020 or 2021? It might be beneficial to push that out, or if it's a way to bring your income down, to bring yourself under that $85,000. So then you're not paying the 24 percentile, you're in that 22 percentile. So just another kind of way as you're strategizing and trying to figure out, well, what should I do? And I know we've heard that in the group a number of times. They're like, well, should I do this or should I do that? Well, it kind of depends. It kind of depends on where you are in the tax brackets, and will it force you in a higher tax bracket? So maybe that would be a timing decision in terms of when or if you should.
And like you said earlier, now is a great time to kind of look at, okay, what kind of timing things can I do with my income, so that, okay, if I know I had a lot of income this year, let's say you had unemployment income and you didn't have taxes taken out. So you know you're going to be taxed on that money, but you haven't paid any taxes in. So it's a good idea to kind of look at your overall taxes. What if you were working at the beginning of the year and you had some withholdings, kind of playing around that. Now I noticed in the chat, go ahead, Rosa.
Oh, I was going to have a couple of questions. One says, why is it better to file married versus single if you are married?
If you are married, so, and we'll talk about this in a couple of slides next, but the government incentivizes people to kind of behave in a way that whatever they deem is a good behavior. And so there is an incentive from the government for you to actually be married. If you file married filing joint versus married filing single, there are tax credits that are available to you as married filing joint that aren't available if you're married filing single. And then also two things. If one person itemizes, then the other person has to itemize their deductions as well. And that could be huge in that, let's say the two people are separated and the wife is in the house, and so she's going to claim the taxes and the mortgage interest on the home. Well, the husband, if he doesn't have another home to claim that, he can't take the standard deduction. He has to take his itemized deductions, which may be only medical, and if they only have that one home. If the wife is claiming the home, then he doesn't have that same deduction to claim, and he doesn't get the extra benefit of having a standard deduction.
So he may have virtually nothing in terms of a deduction.
Right. So see, he's penalized for not filing. It's kind of like the government saying y'all need to figure it out at least enough to pay taxes.
We have another question. It says, so does everyone pay 10% on the income below the bracket level? So anything below the $9,875?
It depends. It depends. More than likely, no. You're probably not paying anything because the standard deduction is like $12,000. So if you get up to 10, then the standard deduction should wipe you out to zero.
And so this would be for the lower end, or if you're a lower income earner, you probably have the standard deduction, maybe some credits and so forth that would get you down to virtually nothing in terms of a tax liability.
Right. And that could be even more important when you're talking about life after fire, because if you have your income, and I'm giving away all the secrets before we get there, but if you have your income in different buckets, then maybe you can decide, hey, whoever's in office now, they seem like they like high tax rates. So I'm only going to pull from my bucket that has already been taxed. Yeah. So like I said before, the government incentivizes us to behave in a way that they deem is beneficial for the overall country. So one example is towards in the 70s, the way people were paid for retirement shifted. So there were more options open up. So that's when 401k started in the 1970s. That's also an interesting fact, and it's pretty cool because we're in this group together. That's also when Black people started being in more corporations, in higher corporations, and kind of like, not affirmative action, but they started to accept more Black people in corporate roles. So you would see, so now they have to, instead of, maybe some people still qualify for pensions. So like, I used to work for a railroad at one point, and most of the older African Americans there were in the union and had qualified for the pension plan. But some of the newer people, they had to just use their 401k. And then the railroad has its own retirement plan. But you get my drift in that the country switched from, okay, being heavy pension focused to individual 401k focus, which puts the onus, instead of on the business, it puts it back on you to save for your own retirement. And then they also, so with Trump's tax cuts, he reduced the corporate tax rate to 21%, which used to be much higher prior to that. And it's 21% across the board, no matter what. And so that is a big deal, because what they're saying is, okay, they're assuming that most people work for corporations, or they want to incentivize corporations to hire more people. And so they say, okay, we're going to give you a tax cut. And so hopefully that money will trickle back to the people, to be determined. So now we're going to talk about some personal income tax basics. And y'all stop me in the chat if you want me to kind of highlight on a certain area. I'll try to answer it as best I can. So this is just the general 1040, which is an individual tax return form that everyone who files taxes, you're going to file a 1040, at least a 1040 if you're a citizen. And so we won't get into, this is pretty self-explanatory. You either single, married, filing jointly, up at the top, married, filing single, head of household. You put in your personal information, but the nitty gritty is like line one. Line one is wages, like W-2 wages. So if you work for someone, and if you work somewhere and they take taxes out, Social Security, Medicare, state withholdings, federal withholdings, you're going to report that the income after those deductions, you're going to put it here. Then you also have interest. I got happy. Dividends, IRA distributions. Notice there's two lines for IRA distributions. Sometimes it's taxable. Not all the amount is taxable for various reasons. Still, if you have pensions and annuities, Social Security benefits. Social Security can be taxable, but it's not 100% taxable. So it's up to like 80%, I believe. You can tax Social Security benefits. And so that is also something to think about when you're planning when you're doing some planning for life after fire. Are you causing your Social Security benefits to be taxed? And then capital gain is line 6. Other income can be business income. It's I'm going to show y'all more in detail.
And Jessica, we might want to just explain what capital gains are, because definitely that may or may not be something that people are familiar with. And especially if you're just getting into whether it be real estate or investing and so forth, you may see that for the first time.
Excellent point. I'm so glad you're with me with this. You're so excellent, I tell you. Okay, capital gains are the difference between, or when you sell assets at gain or loss. So meaning you purchase something, you purchase stock or some asset at an amount. It's called your basis, and you sell it at a different amount. And so if that's a gain or a loss, it goes on this line, the difference between what you purchased the asset for and what you sold it for. And again, that could be a gain or a loss. Now, cool thing about this capital gains is that it has a different tax rate. So if you're in a higher tax bracket, it may behoove you to look and see if you have some capital gains or capital losses that you can utilize, because it can reduce your overall tax. If you have losses, it can reduce your overall tax liability. And that's the main point. You want to reduce your tax liability, but it also has it's taxed at 20% and 10% for people in a lower tax bracket. I think it's 10%. I have to look it up every time. And 20%, because this is one of those rules that changes depending on who's in office, and it kind of changes every 10 years or so.
And I think a great piggyback on that, Amber says, what is your take on capital gains in finance and politically? And Amber, you might have to kind of expound on that a little bit. Are you just saying in finance in terms of, is it a good thing or a bad thing? And then politically, I mean, I guess like Jessica said, it kind of depends on who's in office in terms of what we see from a taxable perspective of those capital gains. Jessica, you want to give us your thoughts?
Yeah, Amber, can you expound on the finance and political, and I'll tell you what I'm thinking about capital gains. I enjoy capital gains. I want capital gains. Sometimes I look at my client's return, I compare it to my return. I'm like, okay, I need to tighten up. I need to diversify my income. They talk about the 7 streams of income. Well, that's what it's going to basically, if you look at your tax return, it'll tell you how many streams of income, because each line is a different stream of income. So in some of the wealthier clients that I have, like people who have owned banks, not like Wells Fargo, but like community banks that just grew over time, all they have is capital gains and dividend income. And it's like $3 or $4 million, so I aspire to be there one day.
And especially, I mean, when you talked about even if capital gains are at 20% versus the top bracket when it was 90%, that's pretty doggone nice. Amber says she was thinking hedge funds and the Black community overall. Definitely, I will say it's more Black people in hedge funds today than ever before. That doesn't say much because it's still very, very, very few. But Jessica, your thoughts?
I don't have any clients that have too many hedge funds. Here in Texas, a lot of people get into what's called PTPs, publicly traded partnerships. And it's basically like oil and gas companies, like they buy shares of an oil and gas company. But what they think, I guess people give them a tip like, hey, if you invest in this, you're going to save money. But a lot of times you end up you letting them hold your money, and then you can't utilize the losses. So it just depends. I don't have that much experience with hedge funds, Amber, sorry. But I think we definitely need, as a Black community, I think we need to diversify. And, if we can help other people have capital gains by selling to one another our assets, especially when we're thinking about changing, like if we want to succession planning and stuff like that, that could be a capital gain. That is a capital gain. So it's important.
And Amber, I'll say thanks for bringing that up, because I definitely want to have a time where we talk a little bit more about hedge funds, because we've moved from a point where only certain investors could invest in hedge funds There are a lot of changes that have happened over the last couple of years, especially even with hedge funds being available within a company retirement plan. I don't know how long that's going to last because my personal thoughts are more than likely enough employers are going to be sued behind it that it might actually become less prevalent. But I think it would be helpful to have a better understanding of what they are, the value of them, investing in them. It can be a part of your diversification strategy, but really just making sure you understand how to evaluate them too.
And can we take a quick little detour, just a little side street? What do you think prompted people to put more hedge funds inside retirement accounts?
Legislation allowed it. That's all.
So that's all you gonna say about that?
That's it. Legislation made it available. Part of that came from hedge funds wanting to increase the number of people that they can have investing in their funds. So that's through politically maneuvering through the system. That's simply what it is. There are trillions of dollars in retirement plans today, and hedge funds that I want in too. So that's what happens when you're a hedge fund and you can lobby and get yourself on a platform. I mean, I don't know, most people may or may not know, I actually work in the retirement industry. And so when we talk about how mutual fund companies are always vying to be on someone's platform, it's a pretty big deal. It guarantees you a certain amount of income that continuously goes pay period by pay period. You're getting more assets. And simply put, hedge funds want some assets as well. So pretty simple. I mean, it's lobbying, it's politics, and money.
Money makes the world go round sometimes. We have another question about hedge funds, Rosalind. If you could just do like a synopsis of what hedge funds are.
Hedge funds could be a few different things because they can be set up in a number of different ways. Typically, hedge funds were only available to a select group of investors. Those investors were typically high net worth. They had to be qualified, high net worth, high liquidity. They were not available to the general public because they do have more substantial risk. They are not going to be like your simple mutual fund. So we'll definitely dive deeper in it because they are coming downstream. Because what happened initially, if you wanted to invest in a hedge fund, you may actually have to have a net worth of somewhere in the $50 million range. But although there's a number of people who have that type of liquidity, there are a number of people who don't. And so to make it more accessible and have the ability to access more clients and get more capital in, it just provides that option. So they might actually purchase organizations that are failing, and they'll take higher risk in order to come in and be profitable. Sometimes it works. So they may buy a failing retailer, restructure, sell it in the open market, those kind of things. There's a number of different things that they can do within that hedge fund, but it's a lot higher risk. And that's one of the reasons why it may not be a fit for people who have $50,000. And so for that, you had to be a qualified investor. So it's definitely something that most people probably haven't experienced a lot more with, but we should definitely get into it, especially because it's likely that some larger employers will start to put it on their platform. It is also very likely that those employers will be sued. Like I said, I work in the retirement industry, and we follow these lawsuits literally weekly. And there are certain large employers that have been sued. The largest lawsuit for a retirement plan was Lockheed Martin. So that's literally like in my backyard from where I live and so forth. So putting certain funds in the platform carries a certain amount of risk for the employer, but we'll definitely kind of dive into that because I could go on for that on like hours and hours. But yeah, we'll definitely go
back on the main street.
Yeah, I'm putting that on my list.
Okay.
You always give good topics.
All right, y'all. So we have come down to, we're on other income, and we're going to go back to other income. So once you add all your income together, you have the total, which is 7B. And this tax form has changed in 2018. They thought they were going to, if you ever heard anything about the postcard, they thought they were going to make it like smaller. And it's basically, it didn't work. And a lot of old school preparers, they don't even like to look at this form. When you look at some of the tax software, they'll show it in the in the old school form. Let me go back. I get excited. All right, so we're on 7B, which is total income. Then you have adjustments to income from Schedule 1, line 22. That's line 8A. And what that is, those are actually called above the line deductions, and we're going to talk more about what above the line deductions are. And then you have your adjusted gross income. So you total all your income, W-2 wages, interest, dividends, capital gains. Then you subtract any above the line deductions. Then you get your adjusted, the difference between all your income and your above the line deductions is your adjusted gross income. So that brings us to line 9. Line 9 is the standard deduction or itemized deduction. And you probably have heard of that or more familiar with the standard deduction or itemized deduction. These are what we consider below the line deductions. And the standard deduction, you take the standard deduction if you don't have enough deductions if your itemized deductions are less than your standard deduction. The standard deduction, you can see it on the form. For single person or married filing separate, it's $12,200. Married filing joint is double that, which goes back to Aaron's point on what's the difference between married filing separate or married filing joint. So even the standard deduction is $24,000 when you file joint, and then it's only $12,000, which is half of that if you file separate. Head of household is $18,350. And then there are some additional deductions you get if you're over a certain age and if you are blind or deaf. So those are what we consider below the line deductions. And the next line is what's called QBI. This is fairly new. Again, this was part of Trump's tax reform, and it gives businesses a deduction based on a vast amount of criteria. So it can get complicated. It can be really simple. It could be just 20% of your gross income, or 20% of your gross income, or it can be complicated by other things that change that amount. So from that, just to recap, you have your income numbers, which is your wages, dividends, Social Security, capital gains, business income. Then you subtract your adjusted gross income. And then you subtract either the standard deduction or the itemized deduction. Now, I'm going to go into more detail about what the standard deduction and itemized deduction and above line, but I want to show you the tax form. From that, you get your taxable income. So going back to Kimberly's question, I had to look at the tax form and now I could better answer it. So by the time you get to your taxable income, let's see, on the bottom of page 1 of the tax return, the taxable income, that's the amount that's going to be here. So 0 to 9,000, after you've done your standard deduction, your standard deduction and your above the line deductions, you're going to be between 0 or 9,875. So everything under 9,875 is taxed at 10%,
KB. So if you only made, for example, since the standard deduction was $12,200, if you only made $12,000, in essence, you would have made 0 for that year, correct?
Mm-hmm. Yes, correct. Correct. And that's kind of where you see some of these memes out here about, oh, you could pay your child $12,000. That's not 100% correct. Don't follow that. We could talk later about I could do a little 5-minute something on different things to do to involve your kid to kind of get them some income, but then also reduce your expenses. Because if they do have a real job, you can pay them, but you still need to give them a W-2, because how do you prove that they had a real job, and how you prove they had income? And how do they file a tax return where they don't pay? And then also kids don't have this, they don't get the standard deduction of $12,000. They have a different, if you are a dependent of someone else, you have a different standard deduction. So let's go back. All right, and so this is the second page, and it just breaks down tax. So going back to that, we just talked about the progressive tax rate. So you would calculate the tax on line 12, and then there's some credits. There's various credits that you could be eligible for. And then line 17 is where you would list your federal withholdings. So the taxes that are coming out of your, if you work for someone and you know that taxes are removed from your check, then part of what those taxes are the federal withholdings. And so that amount would go there. It's not the Social Security and Medicare portion. That has nothing to do with the federal tax. And then the state income tax that is withheld is not going to be on this portion of the form. So you got your income, you got your taxable income, you have a tax amount, and then the withholdings reduces the taxes. So let's say after you calculated the tax, you have you owe $2,000 in tax, but you've had withholdings of $5,000. So that's when you would get a refund of $3,000. There are some other tax credits. I'm not going deep into tax credit because it's a lot of, it depends in the credit land, in tax credit land. So again, if you have a refund,
what's the difference between a tax credit and a deduction?
Yes, you keep me on point, Roslyn. Okay. So a tax deduction reduces the taxable income. A tax credit reduces the tax. So after the tax is calculated, you want to have a tax credit. A tax credit is better than a tax deduction because after the tax is calculated, it can reduce the tax because that's what you're paying. Well, it also depends too. Let me backtrack. It also depends because if the credit is not refundable, if not a refundable credit, then if I have the option between having a deduction and a non-refundable credit, maybe I want a deduction. It just depends. Did I answer your question, Rosalind?
Yes, I have a good answer.
We're gonna do this all day, y'all. This is what we do. We have these kind of conversations. So remember I said we're gonna go back to Schedule 1. This is the additional income. So taxable, the first line is taxable refund. So again, it depends answer, but sometimes your state refund can be taxable on your federal on the federal return. There's some rules around it, but sometimes that's there. Then if you have a business, a side hustle, if you're filing on your tax return, it's gonna go on this line. Line 3 is also would be Schedule C. I'm not going to include a Schedule C. If you have other types of business structure, they would go here. If you have a farm, all my people that are thinking about farming, it goes here, and unemployment income would go here. Also, if you receive 1099s for, so gig economy is increasing. And so if you work for a company like Ship pays you, if I'm not mistaken, they pay you as a contractor. So that ship income would go here on other income, unless you have a business around your ship income, and then you would take that income to another line.
Now, Jessica, I'll go back one more step where you talk about the unemployment income. I know I keep seeing a number of kind of things going around where people are like, oh, I didn't know unemployment was taxable. And especially as we were getting people talking about the extra $600 and so forth. So that could definitely take people into that next tax bracket. So what can people do at this point if they didn't pay any taxes and they were getting unemployment for 2, 3, 4 months? What could they do in order to prevent that larger tax liability in April of next year?
Definitely you want to take some time now. If you don't have a tax professional, you could talk to a tax professional. But if you just have W-2 income and unemployment, you yourself can look at, okay, how much unemployment did I receive? If I had wages in the beginning of the year, how much you can kind of walk through these steps and estimate your taxable income. And if at this point you think it's going to be higher in that you would owe, I would suggest making an estimated tax payment. And all that is you write a check to the IRS, or now you can go online and make a payment if you think you're going to owe next year and you don't want to wait until next year to pay it. Now, some people might say, why wouldn't I? Of course, if I can wait to pay it, I want to pay it. Well, they do penalize, the IRS does penalize you, estimated tax penalty, if you don't pay. So let's say you made $100,000 over the year. If you don't pay quarterly the amount of taxes equal to 25% of your income each quarter, then at the end of the year, you would pay an estimated tax penalty. So this is a great time to kind of look and see, okay, where am I tax-wise and what do I need to do? All right. Okay, above the line deductions. All above the line deductions are not created equal. Above the line deductions, I'm gonna go back to that page. Above the line deductions here.
Now, Jessica, I guess this is we're on the unemployment piece. Someone asks, how does stimulus checks fit into the additional income, if at all? So are they treated similar to like the unemployment check income and so forth?
For now, they're saying it's not going to be. It's supposed to be a special tax calculation. I'm going to show y'all here on page 2. It's supposed to be somewhere in here, probably on schedule 3. They haven't finalized everything yet. And again, it is election year. So and Congress is doing their own thing. So they might change how it's taxed. But right now, it's not supposed to be taxable. So the stimulus check would not be factored in here. It's going to be it's not going to be factored into the tax. It would be an additional credit. So let's say when you got your stimulus check, you had another child in 2020 or in 2019. So the stimulus check and this new tax return will just kind of reconcile those two and say, okay, we owe you an extra $500. But it shouldn't tax you if you received more than you were supposed to. It shouldn't, but we shall see, because things can change.
And then we have another question that says, does it show on the form for the penalty? So if you didn't pay anything and you just waited until next year, will it show on the form a way to kind of calculate that penalty?
It's a separate form that shows the calculation for the estimated tax penalty, but line 24 is this estimated tax penalty, and you'll see it there. And depending on the tax software, or if you have a tax preparer, they should show you the interest and the penalty calculated on what you owe. So if you pay after April 15th, then you owe interest and penalty for not paying everything that you owe for the previous year by April 15th. That doesn't mean you have to file your tax return. That means you just have to try to estimate and make sure you pay enough into the system. Because again, the government is a business and they have to make sure they make money, and they don't want to give you a whole bunch of leeway to pay the bills when you want to pay the bills. They need you to pay it at a certain time. So, and going back to how they incentivize you to act in the way that they want you to act. So yes, long story short, the estimated tax penalty will be there. And then if you don't pay taxes, you have a separate interest and penalties on any taxes owed.
Don't let that
said, don't let that be you.
Don't let that be you.
No, everybody's watching this. That's not going to be them. Not unless they plan for it.
Tell your friends and family so it isn't them as well.
Yes, please. Because I mean, if you enjoy paying that estimated tax penalty, you can gladly pay me that instead, and I can help you reduce that penalty. I will gladly take it. Okay, we're going back to additional income. No, above the line deductions. So above the line deductions, they adjust your income directly. And I have this $ for $, meaning it's a dollar for dollar, just adjusted gross income. It'll reduce the adjusted gross income. Whereas below the line deductions are like indirect deductions, in that you have to have so many before they're useful. And we're gonna go a little bit deeper into this example.
So which one would be better, the above the line or below the line?
I like above the line deductions because it's a dollar for dollar deduction, meaning if you have, and here's the example of above the line deduction. Let's say before we get here, you had W-2 wages of $25,000. If you have health, if you pay separate your health savings account deduction, you pay into your health savings account, you can reduce that $25,000 in W-2 income by the health savings account. Versus if you had just medical expenses, which is a below the line deduction, you have to meet a certain threshold before you can even take that deduction. So you would rather have above the line deductions than below the line. So here are examples, additional examples of above the line deductions. So if you have a business and you pay your self-employed health insurance, if you pay your health insurance yourself, that is actually above the line deduction. That is pretty cool. Because individuals, if you're an employee, you're not taxed on that, on your health insurance portions either. But so this puts people on equal playing field if they have a business and if they're an employee. You also can make contribution to yourself, simple or other qualified retirement plans. See Rosalind for details on what you should do for your individual situation. And then also we have, if you have self-employment tax, you get a deduction for half of the self-employment tax. Alimony is tricky. They changed the rules for alimony. Again, remember we talked about how they'll change the rules periodically. And so alimony before a certain date is deductible, and after a certain date is not deductible. Student loan interest. If you went to a private school like me, you might still have student loan interest. And it is a limit on how much you can deduct. So at most, if there's there's an income limit and there's a limit on the deduction itself. So the good thing is it's above the line deduction, and it's $2,500 is the limit. But if your income is greater than about $68,000, then it phases out. And by phase out, I mean if your income is like 75 or 72,000, you can't take, and you still have $2,500 in student loan interest, you can't take the full amount of the $2,500. You can only take a portion of it, and it's prorated between what your income is compared to that $68,000. And sometimes it is adjusted for inflation, so that's one number you would have to check periodically. And then tuition and fees is also here, but there might be most softwares and will calculate, okay, which one is better for you to take? Is it tuition and fees, or should you take the American tax credit or the lifetime learner tax credit? And it just depends on what else is going on in your tax return, which one is more beneficial. But if you take it here, the other two educational related, like college credits, are credits, whereas this tuition and fees is an actual deduction. So it just depends on which one is better for you, and you won't know until you kind of look at all your tax return as a whole. So these are all the above the line deductions as on the 2019 return as of now. So there is a proposal for 2020 to have above the line deduction of charitable contributions. And I think it's going to be limited to $300. Hopefully, maybe we can put some pressure on Congress to get that number increased, especially if they forgive student loans, then you won't have that student loan interest deduction. And I know a lot of, I think Black people are very charitable, and just looking at tax returns too, looking at the tax returns for various clients, we are charitable. We are more charitable than other people. I could say that from what I've seen. And so with the standard, with itemized deduction, if you're single, the standard deduction is $12,200. So let me just go to the next slide. Which means you have to give, or you have to hit these other brackets on itemized deduction, which is medical expenses. You have to have medical expenses that exceed 7.5 year adjusted gross income. Don't let that number scare you. Property tax, if you own a home or land, you can deduct the property tax. Now, again, another thing that happened with Trump's tax cuts is that it's limited now to $10,000. Now that can be very tricky for several people. Here in Texas, I've seen people pay $100,000 for $1 million property in property tax. So what do they do with the other $90,000 that they have spent on this property tax? That is a pickle. Mortgage interest, all these items again are below the line deductions. They're going to be on your itemized deductions. So the total of your mortgage interest, charitable contributions, medical expenses over that threshold amount has to be larger than the standard deduction, which is $12,200 for single and $24,400 for married, filing joint. And so again, this is why I say that above the line deductions are better than below the line, because you have to have the sum of the total must be greater than the standard deduction. Does that make sense?
Yes, I think so. Definitely let us know if it doesn't. Tweety has a question. She says, is it gross income or net income that's considered when calculating tax on capital gains dividends, and above the line deductions?
Is it gross income or net income? So it'll be, it's, it is not your gross income from your W-2 wages, because if you, certain deductions that you have, certain benefits you have, you aren't taxed on it. Like for instance, we talked about health insurance, you're not taxed on that. If you contribute to your HSA, you're not taxed on that. Trying to think, oh, retirement, duh, that's a big thing. If you you contribute to your retirement, that is not included in the amount that would be reported on your tax return. So gross income, so no, it's not gross income. And net income, we're going to say for the sake of our conversation today, net income is business income, or income minus any deductions. So business income, rental property income, farm income, that net income would be taxed. That is the taxable amount. Let me go back because I can see this probably could be confusing. So if you go here, it all the net income amount would be on line 7A from those items. Line 1 is that wage amount. So if your gross income for, let's say you make $80,000 at your 9 to 5, you're not going to be taxed on the $80,000 if you have other benefits. It's going to be a different amount. It's going to be whatever the 80,000 is minus the non-taxable deductions. Yeah, the non-taxable deductions. I think I'm saying it right. So, Tweety, let me know if that doesn't answer your question, ma'am.
Because I think she's saying too, so dividends, how are they taxed?
Oh, the dividends are taxed at ordinary rate. Let me go back. Ordinary dividends are taxed at ordinary rate, which is the same as it doesn't get that capital gain preferential treatment. Capital gains are, we talked about, it has a different tax rate, and that's just from selling assets. And dividend is actually a return on the earnings of a company. So if you think about it, it makes sense that it would be taxed just like W-2 wages. And then qualified dividends they are taxed at like capital gains. And in order for a dividend to be qualified, it has to go through certain rules. It has to meet certain criteria for it to be a qualified versus ordinary. But ordinary is taxed just like interest, taxed just like your W-2 wages, taxed just like business income. I think that's it. And capital gains it's taxed differently. Yeah, above the line deduction. So, but when we talk about above the line deductions, we would add all those items together and subtract the above the line deductions to get the adjusted gross income. All right. I'm not gonna keep y'all all day. So current ways to reduce your tax. This is what you came for, right? Put a 5 in the chat if this is what you came for. What are your goals? In order to reduce your current taxes, you have to think about what are your goals. Do you want cash now? Meaning, do you want more cash in your pocket from day to day, paycheck to paycheck, or however you're receiving the cash? Do you want cash in a later date, cash in a few months? Some people use a tax refund as a way to save. And I don't think it's any shame in however you choose to use your tax refund. Some people are like, no, you should use all your money now. But if you have to know yourself. If you don't have the discipline to save that extra money in your check, and it's better if you get it during tax season, then that's what you need to do. But you need to think about that when we're talking about, do we want to lower taxes, or what do we want? What's our goal for tax planning? Another objective is, do we want a lowest tax liability right now? Rosa, do you have something to say about that?
No, I think when we talk taxes, when we talk cash, period, when we talk planning, period, it's more about your direction and your goal. I think oftentimes, and like I said, I've been licensed forever and so forth, and oftentimes people will immediately say, what are taxes going to do in the future? And they'll say, of course, they're going to go up. Maybe. because on any given year, they might be up. But I like the chart that you showed us from back in 1913, because literally we're looking at a span of over 100 years. And I might live to be another 100 years. That would be nice. We'll see if that happens. But even if I only make it 20 or 30 years, you can see from that chart that there are some years that it's up and some years that it's down. And that also talked about the top level, or the top number, or the top tax rate. And so the biggest thing about that is, one, that would vary with income as well. I don't know. I don't think that chart showed it, which in some years it'll say the top income is $100,000. Oh, that one doesn't have it.
Mm-hmm.
But in some years it'll say the top income bracket starts at $500,000. And so I'm more of an advocate of being nimble and flexible, because whatever the government wants you to do, I want to be able to respond. So if in any particular year they say, hey, I like homeowners this year, so I want to be able to say, okay, well, let me figure out how to make most benefit from there. Or if they say, preferential treatment dividend income is only 10% this year, then maybe I need to take more of my income derived from dividends. Or when we talk about what's the amount of money that is locked into the retirement system, and if the government is trying to raise taxes, they might simply say, you know what, the RMD, or required minimum distribution age, is now 72. We got all these people that aren't 72 yet. Maybe we want to push them to take some money out. So maybe if we let them take money out when they're 50, it'll only be taxed at 20%. I might say, heck, let me go ahead and make distributions there. And so, opposed to saying this is the order and this is the way that you do things, the thing that we know for sure is that the tax law will change. That's the one thing I'm 100% sure of. We don't know who's going to be in office. We don't know who's going to be in power. We don't know what they're going to want, how they're going to push us. They might be favorable towards businesses, and the tax rate might be low. They might not be favorable to businesses, and the tax rate might be high. But having, when you talk about the multiple streams of income, but also the multiple buckets that you pull from when you get to retirement age, is key, because whatever they like, I want to have that income to pull from. So it might be a year that they like this and I'll pull from this. But if there's another year where they don't, I want enough flexibility in my portfolio that I can say, okay, let me pull from, I know a lot of people talk about like the Roth versus traditional. So if you have a mix, and so the example where Jessica was bringing up the tax brackets, if you have a mix, I think it's like a couple slides maybe from this one. And so if you have a mix and you say, okay, I'm trying to stay no more than the 22% tax bracket, but I still need $60,000 to live off of, you can pull 40 from your traditional and take 20 from whatever avenue that wouldn't be taxed. And then your income is just $40,000. That goes back to when you start to take Social Security income, and 85% of that can be taxable depending on how much income you've made. And so you may have to play with your buckets to figure out, how do I get my income low enough to the point where it can be favorable? I was reading a great article, and Jackie talked about it last week too, when you start talking about things like insurance and the credits that you can get, and it's dependent on the income that you have. Well, you can have a lot of assets, and if you determine where your income is going to come from, you might be a low income earner with a whole lot of assets. And that's where I always want to be, is in a situation where I'm low income, because I can decide where I pull income from. That's just my thought.
It's kind of like the person who drives a Honda or Acura when they could drive a Phantom. It's like, I'd rather have options than to not have options. So I kind of skipped ahead. I'm gonna go back, y'all. I skipped ahead because what Rosalind talked about and Jackie's presentation last week really made us start talking even more. So these are things to think about when you're talking about, when you are for tips, life after fire. I know this, Jackie, this is what you came for. You talked about having a certain amount of cash sufficient, on you at all times, or kind of in your bank account, and you know what to work with. So my suggestion is 2 years, and Rosalind and I have talked about this, and this goes back to just making sure you have the different buckets to pull from. so that, again, depending on what the government is doing, you can adjust accordingly. And another thing about life after fire is you can still build some of these things, and you don't have the same kind of pressure as if your livelihood depended on it. You can build these items, you can build these different buckets out just to give yourself some more diversification from a tax standpoint. So the biggest thing for life after fire is that you want to have these buckets, and you can talk to your retirement person about how much cash you need to have on hand and kind of talk about your withdrawal rate. But if you have 2 years on hand, and Rosalind, you can expound on this, we've talked about this extensively. If you have 2 years on hand, then you have less pressure to, if something happens, to hurry up and have to and jump into something, you know, if you have 2 years of your living expenses in the after-tax buckets. So let me go back. So that's life after fire. And so another assumption I was making with these buckets is that you're not old enough to take money from your IRAs or retirement minimum distributions. You're not at that age. So you're like 59 and a half or less, and you're thinking, okay, what can I do? How can I make this money stretch? And so having these different buckets helps with that. Let me go back. So going back to your goals, if you're an employee or if you're working on becoming financially independent, and you know what your goals are, yes, Jackie, it gives you some breathing room. And you know what your goals are, here's some other things you can do. Contribute more to your company's retirement plan. If you're not maxing out the 401k, and you know you paid a lot in taxes, like now if we're doing more tax planning, you can look at that and say, okay, do I want to contribute more to my 401k? If you do not have a business, you have limited options on what you can do to reduce your taxable income. So one of the benefits, one key thing is, that's why it's at the top, is increasing your retirement plan. And if you don't have a retirement plan at your job, you can still contribute to an IRA, and that would reduce your tax liability. If you are adjusting your behavior, let's say you have learned some things and now you have more impulse control, and you would like to have more of your money up front instead of waiting for a larger refund, or you just want to reduce the tax refund. You see that they passed a new tax credit, or the government has changed the tax law so that it seems like you'll have more money at the end of the year. You could adjust your withholdings and say, okay, I normally get a $5,000 refund. I would prefer to, like now, you say, okay, I want another extra $1,000 to help me for the end of the year. You can look at your withholdings, look at your overall tax position, and adjust it so that you get more withholdings. Now, health savings account, max out your health savings account. It is an awesome way to save on taxes because that money is not tax deductible. It's not taxable. And when you take it out, it's not, if you use it for qualified medical expenses, no matter when you use it, Jackie talked on this as well. No matter when you use it, if you use it 20 years from now, in those accounts, you also have the option to buy securities. So that money can grow tax-free, and then you can reimburse yourself in 2030 for an expense that happened in 2020. And defer, another thing you can do now, you can look at your business income. Maybe you want to defer some income. So let's say you have a contract and you have control of when you receive those funds. Maybe it makes sense, if you're not on like a accrual-based accounting system, maybe it makes sense to say, okay, pay me in January, pay me in February, but have that contract started. And also go back to those above the line deductions, see if there's anything in there you can capitalize on. And if you've been thinking about starting a business, start a business. You have, like I said, you have more leeway on tax planning when you have a business. For instance, I'm not giving you specific tax advice. This is just a general thing. If you have a company and you are you have to use your cell phone to call clients, you can now deduct part of your cell phone bill. Whereas before, if you didn't have a business, that was just an expense, a cash expense out your overall household. But now you're still making that same cash expense, but now you can deduct a portion of it. And that's why having a business can be very beneficial. Sometimes people get crazy, they get aggressive. I have a mentor, first Black CPA I ever met, and he says pigs get fat, hogs get slaughtered. So what you'll see is that sometimes people start a business and they want to deduct everything. But the key to, if you don't want to get in trouble with the IRS, you have to think of these two key terms. It needs to be necessary and ordinary for your business. And so that's very specific to whatever you're doing. But you need to be able to justify whatever expense you're taking on your tax return that is necessary and ordinary for your line of work. And sometimes that's not that hard to prove, but you need the documentation around it. Again, if you've been thinking about starting a business, now is the time. Now is the time
And we
to
got
start it and try it.
when would the IRS say that's not considered a business? Is there an amount of money you have to make to be considered a business?
There is not an amount of money, but they can't go back and say you're really a hobby. So you have to make sure that you're doing things to prove that you're actually a business, meaning you do some kind of marketing to, you got proof that you are marketing to people to get clients. You're not just trying to pile these expenses on your tax return. There's not like a set amount that the IRS says, okay, they only made $5,000. So I don't think any of this is business, because, when you first get started, you might have those low years, but they look at 3 out of 5 years, you should be making money.
So if you were losing money for 10 years, that might be a problem.
If you were losing money for 10 years trading horses, they're coming for you. They are on the highway looking for you. If you, even if you have a Mary Kay business, if you've been kind of keeping receipts and stuff like that, you might have more than those 2 years of losses with a Mary Kay business, but you need to show that you've been putting your feet to the pavement and really trying to get appointments and hire a good accountant if the IRS ever talks to you. If the IRS sends you a letter or anything like that, hire somebody to help you navigate that conversation, but cover your own butt first, so nobody has to jeopardize you or themselves to help you.
And Jordan says she was told that if you don't profit after 3 years, they consider it a hobby.
Yes, that's what we're kind of what I was explaining, is that they can consider it a hobby, but I have clients that I'm like, I don't know why they haven't received a letter yet from the IRS. But again, if you can prove that you were actually trying to make money, and maybe on the 3rd year you made money and you had net profit, but the next year you had losses, then it could, you're in that gray area. The IRS can always come back and say, well, actually all of this is a hobby. They can always do that. But the thing about the IRS is that you are allowed to defend yourself. So if they make an accusation, you can come back and show proof why it's not true, and then somebody makes a judgment on that. So I think we need to be wise, but we shouldn't be fearful and not take advantage of some of these opportunities just because we're afraid of the IRS. They are the greatest bill collector ever. The IRS can go into your account and take all your assets at any time if they know the account number. So I understand that is very scary. That can be scary. But if you're doing what you need to do, you keep some proper documentation. Hey, if they come back and say it's a hobby, then you just pay the tax bill, and hopefully you don't have to pay that much in penalties.
And I'll say not all businesses are the same. So if it's a Mary Kay business and you're negative income for 10 years, yeah, that might be a bit of a problem. I have had clients who were significant negative in terms of income. They actually did research for pharmaceuticals. And so
Yes.
the stream was, you're typically negative 5-7 years. All of a sudden, you make whatever drug it is, the coronavirus vaccine or whatever that might be, it will wipe out all of those losses over the past 5, 7 years, what have you. So not all businesses are the same. And so it's really important to have someone that you're talking to, because one thing that they're able to do as well. So as a business, you're going to put a couple of different things, identifiers in terms of your type of business, to see, does that make sense for your type of business as well? If I'm doing hair and losing money for 10 years, that's not the same as if I'm, coming up with the next big drug. And so those companies look the same, or should trend on average about the same. And so you just want to make sure that you kind of look like the rest. So definitely, look at your deductions, make it make sense, but make sure your trends are in the right direction too.
I'm trying to type in the chat. I'm doing team do too much right now, but I love how you just put a bow on that. That is key. All businesses aren't created equal, and so again, just going back to that fear factor and not being afraid. If you are genuinely trying to make money, you have a leg to stand on, and definitely if you're in something that requires a lot of research up front, the IRS is not as stringent. And a lot of this depends on the tax code that you list on your return. So there's a business code, not tax code. There's a business code if you have a business. And so based on, they group all the businesses together that have that same code. And so they kind of know what the trend should be. And that's what Rosin was talking about. Like, are you on trend? So in comparison to other companies in the same industry, how far are you outside the averages? Where are your variances? All right. So yes, and we already talked about life after fire and making sure that you again have diversify the income, diversify your income, diversify the taxability of your income, because like we were talking about earlier, I need to go back to this slide one more time because it's just something. I feel like we need to just look at one more time. So during the Great Depression, well, several people didn't work. I was going to say laid off. Were out of work. You had tax rate of 63 to 80%. So it's not unusual to think that we could go back here. We have I meant to put a slide in here about the debt. Let me see if I can do that. Y'all give me 5 minutes. Give me 5 more minutes of your time. And if you have any questions, go ahead and put those questions in the chat. Go ahead and put those questions in the chat. I want to pull up the United States debt clock and show y'all.
That's depressing.
I just want us to be prepared.
Oh, this is a good question, Tweety. Is there any way employees can deduct work-related expenses? She says, I used to be able to. I still buy things from work from her paycheck. And it's funny because we were literally just talking about this earlier today. So, Jessica, I'll let you answer that.
Oh, shoot. Again, trying to do too much. Let me change it back to my PowerPoint. Yes, so as a part of the Trump tax cuts, he did away with that deduction. So it used to be on Schedule A. Let me see if I can find a Schedule A too. Now you ain't got me all excited. Schedule A, it used to be itemized deduction for employee-related expenses. Dun, 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 I found it. And I'm going to show y'all. I think I got to stop doing my PowerPoint. Can you see it, Rosalind?
Yes.
You see that screen? Okay, here, job expenses and certain miscellaneous deductions. This used to be what is called a 2% deduction, meaning you only had your adjusted gross income. Remember, wages minus above the line deductions is your adjusted gross income. So let's say that number is 100,000. So it used to be that, this is an old 2017 Schedule A. It used to be that you could take those unreimbursed employee expenses and put it here on line 21, and a few other expenses like safety deposit box. There were a few miscellaneous deductions you could take. So long story short, you can no longer, that is gone. This here is gone. So those expenses are just lost. Just like the client I was telling y'all about who had the $100,000 in real estate taxes here in Texas, which is not uncommon because we don't have state income tax, so the real estate taxes are a little bit higher. So those deductions are just gone unless they bring them back. They're supposed to come back in 2025, but we shall see. Right now, that was my point about this debt clock. Can y'all see the debt clock?
Yes.
Okay. This is our nation's debt. This is the amount of debt per citizen, $80,000. This is the amount of debt per taxpayer, $213,000. So we need, as a country, in order for us to be a sustainable country, eventually we need to reduce this debt. So in order for the country, which makes money by taxing its citizens, to make money, it's highly likely, it's not unreasonable to think that they will increase the tax rate. And so that's why I'm just harping on this, because it's very likely that the tax rate will go up. So it's important that you do things now and think about, okay, what if it does go up? What can I do? If it doesn't go up, what can I do? What are my options? And really, let's be more proactive instead of being reactive with taxes. And that is the whole premise today, guys. Did it go back to the other screen?
No, we're in the PowerPoint.
That's what I'm trying to do. That brings me to the end of the PowerPoint. Y'all let me know if y'all have any more questions. Going back to these buckets. So yeah, that's why it's important that we don't know what the future tax rate will be. So get buckets, diversify your income, diversify how it's taxed. And if you have any questions, email me at jess@worrylesswithjess.com. That is my cell phone number. If you have, if you want to text me and say, hey, I got a question, I'm more than willing to do like a 15-minute discovery call with you guys if you have questions to see if I can help. And it might be that you're not a good fit to be a client just because you might not need my services, but you just have a quick question. Shoot me an email, call me, and we'll see what we can do.
Sweetie, I think you made a great point. You said that's what's scary about the Roth. I have to pay taxes now to avoid later, yet I need to not pay taxes now as well. And so I think that is a continuous pushback that I do with some people who are like strictly just do Roth. I like the calculator that you mentioned on the on kind of the debt for the US right now, because as that continues to go up, and the government looks for ways to come up with revenue, one of the things they could say is, hey, all this pre-tax income, let me give you an incentive to pay taxes today. And that incentive could be, hey, we're going to tax it like dividends on the first $50,000 or whatever that might be, because there are trillions of dollars sitting in pre-tax type account or tax deferred type accounts. And if that's the case, in that year, I might decide to pull money from there, which would be a lower tax bracket than I would have paid on my today income. I am a huge proponent of being nimble and having ways to respond. But I'm a big proponent also of having a relationship with everything from a financial person, a tax person, because like I said, I was talking to Jessica earlier about some of these expenses in terms of how do I allocate them so I can write them off. So if it's an expense that I am not getting reimbursed for my 9 to 5, because things like my home office, those kind of things, no longer expensible. But one thing I can do is, can I transfer that somewhere else? So would it plug into another bucket in terms of my income? So that's part of that tax planning. And so unfortunately, some people don't think about tax planning until January, but by then, you've missed out on a number of opportunities that you would have had. So Tweety, I think it's just a really good thing about how do you get the balance? So no, I don't want to pay taxes later. I don't want to pay taxes today, but what do you all favor today is kind of my thought. And so I don't care who's in office, whatever it is that you like and you're going to tax at the lowest, that's where I want to generate the most of my income from. So that's my thought. My thought doesn't necessarily make it golden or correct, but it's just another way of thinking. I was talking to someone else and I said, this is an unconventional way of life. This is not the work 40, 50 years, retire at 65, get a pension and Social Security, and sit on the porch drinking lemonade. This is definitely a different lifestyle. So you have to be able to kind of think outside of the box and understand that there are going to be things that you can't access at certain times. So there's timing of your distributions. There's the order of distributions. Jackie did a great job in kind of talking about that last week too, and understanding that tax plays a part in that. But one thing we know for sure, we're going to owe something in taxes every single year, and that's going to change. Up, down, it's just going to change.
Exactly. So it's just best to kind of just be as prepared as possible and have faith for the rest.
Perfect. Any closing remarks, Jessica?
I'm just so happy to be doing this with you. I'm gonna love on Rosalind. This is her idea. This is her baby. We are only 2 months in to this process, and if y'all go back and look at that first one we did, ooh, improvement. I like to see improvement. Thank you for the opportunity. Thank you for pushing me to put myself out here more. I do have a firm. I do prepare tax returns for people. I do tax planning. So again, if you have questions, let me know. It's not that I'm gonna charge you for every question, but I like to help people too, probably too much, but I do like to be helpful. So if you guys start, if you do a tax calculation, you're like, hey, can you just look at this? I don't mind doing that as well.
Well, I want to thank you so much, Jessica, for joining us. I want to thank you for this information. I think sometimes for years, I just used like a TurboTax, and I was like, I can do this on my own. I don't need anybody. And it was valuable for me to have someone that wasn't simply a tax preparer, because a tax preparer is reactive to whatever it is that you've already done. Versus someone that you can strategize with in the off time. So after it's all said and done, as we're planning for what the heck is going to happen in 2020, having a relationship with someone I need to talk about where my income, one, needs to be. I don't want to pay taxes today, but at the same point in time, I own a business. And so if I want to be in a situation where I can get more capital and so forth, I need to show a certain amount of income. So we kind of have to teeter the line between paying something versus planning as well. So having that person as a part of your team, find that person. Jessica might be that person for you, but definitely create your overall team. I'm doing a presentation talking about your kind of board of directors, but create that team so you can run these questions by, because something that may have been deductible 2 years ago may not be deductible in 2020 or 2021. So you want to be prepared for that as well, and don't necessarily just get all of your advice from just anybody who posts on social media and so forth, because sometimes I see things and I'm like, oh gosh, that's horrible advice. So I want to thank you for joining, but I want to thank our professionals who always join and give us great sound advice as well. Of course, once again, our sponsors, Eureka, there is a great resource, or a number of great resources there that can help you, everything from tax, legal, and so forth. But also, if you have any speaker or any topic recommendations, always let us know, because this was a recommendation from Tweety. So I wanted to make sure that I gave you a shout out for that. Thanks so much for kind of putting that back in the mix. And yep, Jessica already posted that email. So thank you so much for joining us. Thank you so much for Eureka, and same time next week. Have a great day.